Welcome to the Daily Briefing from Interest.co.nz. I'm David Chaston. Today we review the Fed's rate review overnight, look at the mortgage market for September, update the latest business confidence readings, and we'll wrap up with what the other media are reporting. Today the US Fed cut its Fed funds rate by 0.25%. That was less than some were expecting a week or so ago, but the US economy is doing a lot better than many were predicting as well. In a separate announcement, US authorities said their economy grew at a rate of 3.9% in the third quarter. The Fed said this interest rate cut should help forestall some of the adverse effects on the broader economy that might arise from disruptions in financial markets. The whole tone of their announcement was a lot more positive than was expected. The housing slump is clearly a concern, but the unexpected acceleration in economic growth in the third quarter on the back of an increase in exports, consumer spending and business investment more than made up for the plunge in home construction. We reported yesterday that our mortgage market broke through the $150 billion level for the first time in September, and that most of the lending was by banks, and especially the four big banks. But that growth did slow noticeably in September. This was the first month in over a year that did not add more than $1 billion to net new mortgage business for banks, and the third slowest growth in over 3 years. Borrowers are moving out of one-year fixed mortgages at a fast clip and primarily taking up 2- and 3-year arrangements, which is the sensible thing to do. It also seems the demand for 5-year fixed terms is losing its appeal. Some institutions are more reliant on residential mortgages than others. ASB, for example, has more than 63% of their total assets in residential mortgages. Kiwibank has 73%. TSB has 60%. The other banks have a better spread between housing and non-housing lending. ANZ and Westpac each have about 45% exposure. BNZ has 42% exposure. The lower exposures of these three banks help keep the industry overall exposure levels at a steady level. The housing market may be slowing, but credit demand from businesses remains high. The September data shows that this grew an impressive 16% in the past year. Spring is in the air and business confidence is improving noticeably. And one sector that stands out with fast improving confidence is the construction sector, whose confidence surged to an 11-month high, although this was more like a recovery than a leading trend. An improvement in outlook for firms' own prospects was noticed across the board. Even farmers recorded positive sentiment in this measure, which is unusual for them, and especially as the exchange rate is not corrected down in the way that many of them would have liked. One disconcerting trend, however, is that many more companies are planning to raise prices. The inflation outlook will not be as flash if this comes to pass, and this survey shows that firms are expecting to be hit with higher costs as well. And finally today, a quick wrap-up of what the other media are reporting. The concern over high oil prices is waning somewhat. True, they are higher, and that is flowing through to higher pump prices, but this cost does not have the dramatic impact it once had. All sections of the international economy is now much more efficient, and this is especially so in the developed world. Geneva Finance has made a last-minute plea to its investors to vote in favour of a rescue plan which will prevent them from pulling their money out for 6 months. Apparently KPMG suggested that because Geneva's assets significantly exceed liabilities, investors would have to weigh up the risks of allowing the company to continue trading or seek to get their money out under the protection of a receiver. MFS says it will compensate clients for any losses they sustain after their advisors put money into failed finance company Bridgecorp. You get more news and stay up with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.